Hey everybody, it's Alloy, and I thought today to make a tutorial about something called the Contrarian investment strategy. Before I begin, I would like to apologize for any background noise you might be able to hear right now. There are some people blowing leaves with really loud equipment in the background, so I'm able to hear it even if you're not. Um, anyway, here I have already in front of me the dark pool trend graph, and hopefully folks are familiar with it. But in case you aren't, I'll just do a quick rundown. We have dark pool, which is the teal line. That is basically how really wealthy hedge funds are spending their money, and some other difficult to observe trades, kind of data that's hard to get because traditionally it's on a market that is hidden from the public market. So just kind of a neat data. It's hard to acquire. Then we have options risk, which is actually gamma, which is basically how likely are options likely to move based on underlying price movement. What is if the underlying asset goes down? How likely is that to affect contracts? Basically, by what magnitude? So puts would go up, calls would go down. How sharply would those two things occur? That's gamma. So that's options risk. And then for the S&P 500, it's exactly that. It's the S&P 500. So before going into great detail about the contrarian investment strategy, which is what this video is going to be about, I want to just talk about a trend here that will sort of assist in strengthening the conclusion that I'm going to throw your way in just a moment. So what we see here is three things as usual. We have the dark pool going up, the S&P 500 going down, and options risk going down. Suggesting that expectations in IV are sort of normalizing or at least hitting a local minimum. That's why gamma or options risk is relatively low. Then we have the S&P 500 taking a big dip, and while it's done that a few times, we notice that in other times the dark pool is getting out, even when the dip is there, even when it's going up. And then when it tends to go down, the dark pool buys a lot in huge volumes, right? So there's never been a better time to see this actually than like this week. And if you look at today, we've had a relatively good day. I think my portfolio is up like 7% or something along those lines. So really good day. And again, it points to one of those scenarios where the rich people clearly knew the market would be going up today. It was all of us jokers over here that don't already know it, right? So that's why we have the dark pool graph to sort of get a peek into the information that they have and sort of coattail off of that. So now that I'm done explaining that, how does that have to do with the put call volume and the contrarian investment strategy? So the trick here is, first of all, you need to understand this ratio. This right here, just to put it in one example, one sentence, hopefully gets across, is 0.86 means that there are more puts than calls being written and bought right now, being traded. That's literally what it means, a higher volume of them. It's just leaning a little bit more toward the put side. The average area is a zero point 0.7. I'm not going to go into why it's a 0.7, not a 0.5. Basically, it's not a scale of 0 to 1. It's a scale of 0 to much, much greater than 1. The ratio could technically be huge. It's just not very common. So zero point 0.7, though, sort of over the evolution of the stock market and the culture behind it, is where experts have learned is sort of a normal area. So what does that mean for last night's data, which we're looking at right now? 0.86 is a little bit above that quote unquote normal range of 7. So there are more puts being bought right now than calls. Okay, now that we've established that, maybe you're thinking, in combination with that thing I started with about the market being up today and rich people knowing it would be up, why on earth would there be more puts? Okay, that would be a great question. I hope it's the one you ask to yourself or something along those lines, but it's okay. In any case, the answer is twofold. One, it's very common or commonly understood that options buyers, i.e., gamblers, the people that people who have a lot of collateral right to. So when I'm writing a call, the people who buy that call, or the person who does, they are 90% of the time going to be wrong by the expiration date, right? So there's a 90% chance that the person who bought a call or a put isn't going to be out of the money completely by expiration in a bad way. It's not going to go the direction they thought it would 90% of the time. You can apply that to your own experiences however you want. Maybe you think you're better than that, but that's the average, right? So that's worth considering, is that you maybe want to bet against this bearish Signal, because 90% of the time the purchasers of these puts are wrong. Okay, so that's the first argument. I said it was twofold though, so what's the other thing? The other thing is rich people buy puts to hedge their greedy positions. So if you take that into account and then you look at this movement right here, the trend with the dark pool, options risk, and the S&P 500, no doubt they made a lot more money than just someone holding like me today because they timed it on a day-to-day basis like they do. They're making millions every day by doing these folds and putting the money back in the market, folding it again, stuff like that. They're making huge amounts of money. Now you could try to do that, but also you could look at it this way, right? You have people buying puts more than calls right now because they're actually feeling bullish. Now, what do you do when you're bullish? Maybe someone out there is thinking, well, you put all your money in one basket, right? Well, maybe that's what you do. But really, really old, smart money, they don't like doing that. So they actually hedge when they think it's a bullish market. So the twofold in a shorter version, right, can be explained by this. One, options buyers, i.e. retail investors, people on Wall Street bets, Robinhood users, etc., they're usually wrong, first thing to note. So if you're looking at it that way, you could invert it and you would be right. The market went up today. So last night, signal should have been inversed. Okay, there's that aspect. Then the other one is that even if you believe that smart money is buying a lot of puts, you have to ask yourself why. It's not because they're cocksure. It's not because they're super confident it's going to go down. It's because they're hedging the fact that they think it's going to go up. And here's the math also, the common sense that we can't forget when talking about the market at any time. If the market goes up, right? Traditionally, that's its job. That's its function, that's its role in our economy. And frankly, the more people that are born, the more people having babies, getting jobs, spending money, the market is going to keep going up. It's sort of a human history thing, so far as we're able to observe. So buying puts is always risky. I just want to say that. Typically, when you see a signal above 0.7, it looks like people are feeling bearish. Double check your assumption. Ask yourself, are they really feeling bearish or are they hedging their bullishness? I think you'll find out that they're more often than not hedging their bullishness. All of this info combined can make you a really clever weekly swinger. If you're really feeling bold, you could be a day trader. Even I don't have the time for that nowadays, but some people do, so more power to you. But hopefully, like the rest of the videos, I've sort of glued together these things and illustrated practically how you can make more money daily. And this is something I've been thinking about. You can't see it because I have it cropped, but I actually have my Robinhood up in a tab. And I'm thinking a little bit about how I can find these dips and maybe sell off like they're selling off and then capture the discounted buy, just kind of maximize my buy sell rotation strategy. So I hope this helped you guys do the same thing. I'm going to choose to be a little bit more aggressive in the coming months as we hit, really the first half of 2021 for real. So happy New Year if I haven't said it to any of you yet or the folks watching. And I hope it's very fruitful. Keep using digits and keep asking great questions. Thanks for watching.